recently, I think people have been worrying a lot more about, about the government shutdown, whether or not, tariffs over a longer period of time will do a little bit more damage than what we've seen so far year to date.
I'm Stan Barnes, and welcome to the 25th edition of Barnes Quarterly. We're here in early November, and it's hard to believe, we were talking before the podcast, it's just hard to believe that we're already in the fourth quarter of 2025. Eddie is out in the field. This quarter tends to be really busy for us as it's year end, and we're out trying to communicate with our clients and their employees, but he's in the field at an enrollment meeting, and so he'll be patching in by phone. Eddie, you there?
I'm here. Yeah, I'm on the road today, trying to fit it all in.
Well, the S&P 500 this year to date, is up about 17.5%. So it's really been a great year. We're just past a pretty big holiday, particularly at the Hatch House, and that's Halloween. Eddie, tell us about what the costumes were, what the candy was, all the details of your Halloween season.
Yeah, with 3 under 9, Halloween is a big time of year at our house. We have some couple of big Wicked fans, and so they dressed up as the 2 witches from Wicked, and then we had a wolf running around the neighborhoods trying to collect as much candy as possible. But they have a blast during Halloween, and they love getting out and collecting as much candy as they can.
Well, what did you dress up as?
I'm scary enough as I am, so I wore my normal clothes.
All right, not a Florida Gator.
No, I'm in hiding this year. We've had a rough season, and we're looking for a new coach right now.
Speaking of which, we are in the thick of college football season, which is one of my favorite times. But some of us are in a better mood than others of us are at this point, and there's pretty widespread shakeup in the coaching carousel right now. It looks like there may be some more of that before we get to the end of the season. But as is tradition, we're going to be joined today by our Chief Investment Officer, Chris Zaccarelli, who has been very busy with us and our clients, as well as, putting some word out in the media. And we'll talk a little bit about that later. But here he is. So, Chris, glad to have you with us this afternoon. You've been following you. You've been doing some interviews on the media, and saw that you had a nice write-up in the October 21st edition of the Wall Street Journal, in an article titled, "When Wealth Triggers Worry, Advisors Explain Clients' Biggest Financial Fears." So in like 3 minutes, go ahead and do that, would you?
Yeah, I mean, clearly being in the media, you get a lot of different questions. It seems like people have pivoted from everything is going well to, what are people worried about? What are keeping people up at night? And there's a broad range of concerns that I think people always have. Recently, I think people have been worrying a lot more about, about the government shutdown, whether or not, tariffs over a longer period of time will do a little bit more damage than what we've seen so far year to date. But generally speaking, people's fears will run down to either individual circumstances, so, running out of money personally, or potentially not being able to withstand the volatility in the market, to something a little bit more broad-based, which affect everyone. So like I said, the government shutdown, potentially a black swan event, really all manner of things. And each of those spheres makes sense in its own context. But from where we sit, part of what we're doing from portfolio management as well as the asset allocation, which Stan, I know you and Eddie work closely with your clients in order to match the asset allocation along with your clients' risk tolerance, their goals, their objectives. And then from my point of view on the portfolio management side, really trying to create that diversified portfolio, to the extent that we can identify opportunities, things that have sold off or that are undervalued or that, historically speaking, have good potential within certain scenarios. We look to identify those from an offensive point of view. But from a defensive point of view, really not knowing what will happen in the future as uncertainty rises or as, you always need to be prepared for some type of black swan event. Just having diversification of the portfolio is another way where we can try to make sure that not only are we leaning into trends on the offensive side, but from a defensive position, making sure that we've got a good position across lots of different asset classes, large companies, medium-sized companies, small-sized companies, as well as some international investments, commodities, et cetera. So just having that diversified portfolio really helps you in terms of dealing with uncertainty as it comes. And so that's, in a very short synopsis, some of the fears that I think people have and some of the things that we're doing to try to address those fears.
Well, and I was going to say, this year we've sort of seen a broad a broad selection of asset classes do well. The domestic stock market has done well in recent history, but we've seen international investments really do well, and but the bond market has had a pretty good year. And so, we don't want to borrow trouble, but this last quarter of the year is shaping up to be an eventful quarter. I was saving that, but between the government shutdown, the tariffs, discussions about where interest rates are going to go, and Chairman Powell cast some doubt. In terms of whether we were going to see another cut in December, and just, the headline risk that we're seeing on a day-to-day basis. People seem to be getting, a little tenser, but, we've gotten through October, which historically is not a great month for the stock market. And we're kind of pushing towards the end of the year, and the economy is continuing to show really strong resiliency. And so, maybe comment on that a little bit.
Well, there's a lot of really good points that you've made in there, and all of those are very pertinent to kind of where we stand now. Kind of working backwards. Absolutely, some of the worst stock market drops in history has happened in October. On average, September is the worst month. So although it doesn't always have the worst drops like October does, just on an average basis, it's typically a relatively weak month. So we've gotten through a couple of the more challenging parts of the year in terms of seasonality, in terms of time of year. We really made it through a lot of the not only tariff announcements in April, but the actual implementation of tariffs starting in July. In some cases earlier in the year, but the full rollout of tariffs have started to take effect. And I think the key word you used was resilience. Companies have been very resilient. The economy has been very resilient. And so I think we're facing a little bit of a double-edged sword here in the markets. On the one hand, markets have done very well this year, to your point, across many different asset classes, whether it's bonds, stocks, domestic, international. We've seen very good performance year to date, and we've seen it across a broad range of asset classes. Now, along with that great outperformance has also come valuations getting more expensive. The stock market is much more expensive now than where we started the year. Bonds in general are very expensive in terms of just that margin of safety in terms of either credit quality or interest rates moving. And so we do have markets that have done well. And so therefore, they're a little bit more vulnerable to things that may happen later this year into next year. So, as always, it's impossible to predict the future. But generally speaking, if you've had a good year this far into the year, historically, we've seen a pretty decent rally into year end. There may be some bumps along the way in November, December, as we might get news from, private forecasters in terms of the job market, or, the Fed may decide not to cut interest rates in December. But on the other hand, I think they're watching things very closely. Likewise with the government shutdown, typically speaking, the market will take a short government shutdown in stride. Now the government shutdown is starting to extend. Even if all of the government employees are paid back, those back wages, which they've missed for the past, 36, 37 days, however long the shutdown has been continuing, there is the possibility that, with the government shutdown, especially when you look at FAA air traffic controllers, or even TSA from a security point of view, if it turns out that we start to have, less air travel, less business travel, if somehow that starts to impact the economy above and beyond just government workers getting paid later versus on time, we can see some impacts in the economy. So there's plenty of risks out there, and I don't think we can be complacent and just assume everything is going to go smoothly, going forward. But on the other hand, I think we've really seen businesses be resilient, the economy be resilient, and I think it's one of those things where you just have to maintain confidence in what's been happening so far, but just be alert to the risks that are lurking around the corner, because as always, there are potential downsides.
Very good. Eddie, have you got anything you want to throw out there?
Sure. Chris, up until recently, we were expecting to get a couple, maybe a potential two more rate cuts through the end of the year. And I guess Powell came out and mentioned that he might not cut anymore until next year. But we've seen the unemployment numbers creep up a little bit, sort of implying that the economy is starting to slow down. Are they, which, you would think typically the lowering of interest rates would, be useful to help kind of speed up the economy some. Are they not doing that because they're seeing inflation popping up that they can't control?
Yeah, I think that's a really important question when it comes to, what's the path of interest rates going forward. And so, we as we headed into the fourth quarter, heading into the end of the year, really markets were expecting somewhere between 1 to 3 rate cuts. We did get 2 in a row, but to your point, Chairman Powell at the most recent Federal Reserve meeting pointed out that it's not a sure thing that we'll have a rate cut in December. I think they're trying to keep all their options open. Without a doubt, we are seeing a little bit of weakness in the job market. We had some numbers out this morning that were showing, layoffs are starting to pick up a little bit. Nothing that, maybe this particular month was unusual for having more layoffs than is typical for this time of year. But generally speaking, year to date, or looking back over the last 5-6 years, we haven't really seen, anything that's alarming. It's just, again, you're starting to see a pickup. And so I think the Federal Reserve is just really trying to keep their options open. At this point in time, based on the information we have, I wouldn't be surprised if they were going to cut again. So I think we will see a rate cut in December. However, inflation has not gotten back down to their 2% target. And I think there are some people in the Federal Reserve who are worried inflation, although it has come down a lot from where it was a couple of years ago, is still elevated versus their target. So I think they're trying to keep their options open. They have so far this year decided that, given inflation above their target and yet the job market weakening, all things being equal, they have a bias towards cutting interest rates and basically prioritizing the job market over their inflation target, at least in the short run. And I think as long as inflation stays around the same level or does keep coming down, even though it's coming down much more slowly than they would like, I think that gives them the ability to cut. So as of this time, I wouldn't say that inflation is popping back up or in a meaningful way. However, it is staying pretty sticky, and I think there are people who are concerned that inflation won't get back to target. So it's going to be a tough call. I think markets had the odds somewhere closer to 50-50 after what Chairman Powell said. But I think under the current trends, again, inflation staying maybe consistent and not going up that much, and the job market continuing to weaken, I do think they will cut one more time in December, but we've got a long way to go before that meeting. And as the data changes, I'm sure they'll change their mind as well.
Well, Chris, we really appreciate you carving out some time for us this afternoon. I know you've got a busy schedule, particularly this time of the year, but as always, appreciate your wisdom.
Well, thanks, Stan and Eddie. Appreciate all the questions. As always, I appreciate all the clients who've listened to the podcast and listened to our discussion. It's great to see you in person when we're having those client events. And I also appreciate the opportunity to speak with you, 4 times a year during these quarterly podcasts. So I hope everyone has a happy holidays. As Stan, has mentioned in the past, this is a great time of year, and we're looking forward to everyone having a safe and enjoyable holiday season.
Want to just remind our listeners that we are heading toward the end of the year and need to make sure that you're taking your required minimum distributions. If you're in that age bracket, make those charitable gifts before the year end to get that tax deduction. And also, if you have any tax losses to harvest this year, just make sure they get done before the end of the year, and we can certainly work with you on the accounts that we handle for you. Want to wish everybody and their families happy holidays. We're in the thick of that season, and it's my favorite time of the year. But hope 2025 has been a great year for you, and look forward to speaking with you in 2026.
Chris Zaccarelli are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.